BitMine adds $73 million in ETH, pushing holdings to 4.8% of supply. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. That's how much of Ethereum's entire circulating supply one company now controls. BitMine just added $73 million in ETH to its holdings, and this move signals something critical about institutional confidence in the asset and concentration risk nobody's fully priced in yet. Here's the context. BitMine, a major player in the crypto infrastructure space, has been accumulating Ethereum consistently. This latest purchase pushes their total stake to nearly 900,000 ETH. That's not a trade. That's a conviction bet. And when institutional players of this scale move this decisively, markets move with them. Let's break what this actually means. First, the immediate signal: institutional money is rotating into Ethereum right now. This isn't speculation from retail traders watching TikTok. This is infrastructure-grade capital making a calculated bet on Ethereum's utility. The timing matters. Ethereum's fundamentals have shifted. Layer 2 adoption is accelerating. Transaction costs have collapsed. The Shanghai upgrade locked in staking economics. All of that combined creates a real cash flow argument for holding Ethereum, not just trading it. Second, the concentration angle. This is the part markets are sleeping on. When one entity controls nearly 5% of a cryptocurrency's supply, you're looking at structural fragility. Not in the sense that BitMine will crash the market. In the sense that Ethereum's price action becomes dependent on the decisions of fewer actors. If BitMine decides to reposition, liquidates even 10% of this stake, or gets forced to sell due to macro pressure, the ripple effect across exchanges, derivatives markets, and retail positions could be severe. This is why Bitcoin holders worry about MicroStrategy's position. Same principle here, but Ethereum is less mature and more volatile. Third, what this means for your portfolio or your protocol positioning. If you're running a DeFi protocol or holding Ethereum for yield, concentration in institutional hands changes the volatility profile. It reduces tail risk in some scenarios. Institutional players rarely panic sell, but it increases directional risk. When BitMine moves, Ethereum moves. When Ethereum moves, everything downstream moves. That includes your returns. Now the contrarian angle, because this story gets more interesting here. Some analysts are reading this as a bearish signal. Why? Because it means one entity believes Ethereum is cheap enough right now to justify deploying $73 million in fresh capital. Typically, when the smart money starts buying dips aggressively, the bottom is closer than the top. If that's true, Ethereum could see significant upside from here. But, and this is critical, it could also mean BitMine is front-running knowledge about upcoming catalysts. New staking protocols. Institutional adoption milestones. Regulatory clarity. The buying pressure itself becomes a self-fulfilling prophecy. Here's what changes next. Watch 3 signals over the next 72 hours. First, does Ethereum's price break resistance at the level BitMine's purchase triggered? If yes, you're seeing confirmation of institutional confidence. If no, you're seeing a failed test, which typically precedes volatility. Second, monitor if other institutional holders, Grayscale, 3iQ, other infrastructure firms, follow with their own positions. Herding behavior among institutions amplifies moves. Third, watch for derivative positioning. If open interest in Ethereum futures spikes, that tells you leveraged positions are betting on BitMine's conviction being correct. That's fuel. But fuel can ignite or explode depending on macro conditions. The broader implication is about Ethereum's maturity as an asset class. We're moving past the phase where individual whale moves determine price. We're entering an era where institutional positioning, custody consolidation, and correlation to macro indices matter more. BitMine's $73 million purchase is a small signal of a larger shift. Ethereum is becoming infrastructure. That's bullish for adoption. It's also a reminder that concentrated holdings create execution risk for everyone else. This is why the SEC cares. This is why protocols are building redundancy and decentralization mechanics. So here's the actionable insight. If you're a trader, use this move as a signal to monitor Ethereum's technical breakout potential over the next week. If you're a protocol builder, this consolidation is a reminder to diversify your token holder base and reduce reliance on any single institutional whale. If you're an investor, understand that Ethereum's next leg up will likely be driven by this kind of institutional accumulation. That's both opportunity and risk. The opportunity is real. The risk is real too. Stay sharp on the metrics. Watch the concentration. BitMine's move just changed the game state. The next move is yours to interpret. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.